Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter. There's a lot of stuff I shared on Twitter that I want to talk about. Show you guys, give you more confidence in the bull market that's coming, especially in crude oil. I'm going to show you a little bit of fractal analysis to show you what's coming, and I'll give you my financial opinions as we go. Again, if you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com, that's where we go over the individual companies. There's certain fractals, certain things that I'm going to go over during these Q&As that people want me to go over. The most recent one, we're most likely going to go over how to identify what companies will do what over the next bull market. What am I looking at to identify why I would take a core position in something versus other people's thoughts of why they would select a company. So you get to know at least my approach. So come down, it says taking a step back clears up the picture. This is for palladium. The ratios are right now are not favorable for this metal at the moment, but you can see some clear movements here. So we came up, hit a resistance line, created the resistance line during this time frame. So you put a line across here. We also used it as support later on. We broke out of that resistance line and just ripped it all the way up to about $1,000. So if you had bought on the break, you went from $180 to $1,000 in a pretty short time frame, a couple years. That's how powerful buying a piece of metal is. If you can identify when something's cheap using ratios in history, you buy it at a pretty good opportune time. This is basically a shoulder, head, shoulder. You can buy in the right hand shoulder and get at about $111. Did a 10 bagger, roughly speaking. What is your risk reward on buying palladium, platinum, gold, silver at a very good time? Well, I would say it's probably the best risk reward that the market has to offer. Why is that? Because the risk in metals is so low. There's no risk in terms of management. There's no risk in terms of jurisdictions, on and on and on and on. There's like 10,000 things that can blow up a trade that the metal bypasses. You're not going to get nationalized. You're not going to get higher taxes on the mine. You're not going to get problems with opening the mine or shutting it down or nationalization all that stuff. It just all goes away. Well, either way, it pulled all the way back to that support level. You know what a really good time and a time that I purchased palladium was in this area right in here around 200 something bucks. Came back up, came back in 2009. I bought it again in this time, and I sold it up here. It was in April of 2020 when it was like just past this peak. Maybe it was right here where I sold it. It was like maybe right here where I sold it and swapped it into platinum because the ratio was off the board cheap. And I thought it was pretty expensive for palladium. When you take a big picture view like this, you can see where this is most likely going to come back to. It's going to come back to this support level just like it did back in the 2000s. That would be a really good spot to be looking. Probably 925-ish would be a level that you might want to look at. And it may be down there for a little while. This is going to be a long-term play. So palladium, platinum, uh, silver, and gold are the metals that I use on a ratio basis to increase wealth from what I consider to be the lowest risk, uh, best reward opportunities when I go and I buy them when the ratios are favorable for a certain metal. And we'll talk about what looks favorable. This is crude oil fractal overlay to show how similar the movements are to give confidence to investors of how the herd is lining this all up. So we could look at this. I'm going to bring it up in a different one. So this is crude oil. What I did is I grabbed this bull market So that's the fractal I grabbed. I did that. That's the fractal right here. And what I did is I overlaid it like this so that it's the downward move. I'm going to expand it. Does anyone see that it's basically the same fractal, the same movement? The herd behind this traded this exactly the same. I've now taken this fractal before, overlaid it on this one, and if I were to size it up properly, which is very similar to what I have today, oil would go to $623 if the same size movement and adjusting the fractal to the fractal size over here of this move and the wave one move. We get a 600 and something dollar oil price. I know that sounds ridiculous, and people are going to say, how are people going to afford $600 a barrel? That's always what inexperienced investors say. How are people going to afford that? How is the economy going to do whatever? I'm not telling you guys that the economy is going to be good. I'm not telling you anything. All I'm going to say is the inflation and the dollar is going to eat it. It's going to eat it. And this year, if we break out of this horizontal line, we are going way higher. We're not just going to 200. There's no way that you're going to have a breakout going all the way back to 2008 and we just barely make a new high up to 200, which is here. It's going to run. Each one of these levels, if you were to look back in history and we were to throw some price ranges, this when it broke the horizontal level, it did a 10 bagger from 1973 to 1980. It 10 bagged when it broke out. Then if I take it to the next one, and that came from a very low level here, but it went up 3x. And that was from a level in 1998 of $11 to 142. That was basically a 14 bagger, almost, maybe a little bit less, 13 bagger. So if we were to do the same, now I'm going to go from this area there. If we were to do like a 13, we're looking at $400. $400 is possible from that bottom. A 10 bagger from the top would put us at 1,390. But I know a lot of people are going to say, there's no way. There's no way it's going to go to $600, $400. People can't afford it. What I'm telling you is, it's not about what people can necessarily afford. It's about the dollar eating it. So everything will get repriced higher. It's not just crude oil. It is going to be everything. So that's crude oil there. And I'm talking about watching the horizontal lines. But here's silver. Silver had a double bottom in the 1930s and 40s, and most commodity companies have the same large bottoming pattern today. Silver now has the largest cup and handle pattern that I have seen. Kind of looks like testicles as well in the 30s and 40s. So this is your double bottom. You can see that we were coming in a downtrend. We had the lead-in pattern here. I call it lead-in. Double bottom. It breaks out. Then we have a consolidation on top of it. And then look what happened. This is what comes next. A lot of the companies that we're looking at today are in this location over here. And what's to come is this big move to the right-hand side. It's the big, gigantic move that's going to last for probably a decade or longer. So if we can identify where these double bottoms are, one, that's really good. There's some areas that we are still down here, much like we are with silver right now. This is a cup and handle, and we haven't broken out yet. So we still have a really long way to go. The way that you project this price, so XAG to USD, the way that you project the price here for this is you take your bottom of the cup to the handle portion, you project it on top, and then you get a projection of about 400 something bucks. If you take and create a handle this way, which you can do, Then you would take it from about the breakout point here, and you'd get 350-ish dollars. About 350 to $400 would be the projection on silver. Now, here's the thing. I just told you that oil is probably going to go quite a bit higher. So what I'm going to do is I'm going to throw crude oil in front of this. So this is crude oil divided by X. This is crude oil to silver ratio. Let's just see how this responds. So if we were to go to a crude oil ratio back to 10, which means crude oil is 10 times more expensive than silver. And let's say silver goes to 200, that's $2,000 a barrel oil if it were to do that. But this is probably going to go up at a different time than silver goes up completely. And it may not peak exactly at the same peak as silver. So let's say silver goes to $50 and you do a 10x, that's $500 oil. As silver goes up and crude oil goes up, crude oil most likely peak before silver, and then silver will run off to 2011. So this will most likely, crude oil will go up first. It'll probably do something like this, and then it'll come back down at some other later point where silver will outperform it. This is where silver will peak. This is where oil will peak. It'll be at two different peaks. It won't peak at the same time. So that's my guess. Something like that is going to occur. Right now, this is 98, and it peaked in 2005 for crude oil to silver. We are still really early, and I think we just did the first wave pullback, and then this is going to rip it all the way back up against silver even. Baltic Dry Index, breaking the long-term trend line going way back. Anyone else watching this? So here's your trend line. This is your resistance and support level. You can see we hit it all through history back here. Then we got above it, and it was all about ripping, about to rip time. We came back below it. We broke up above it in 2021, 2022. We pulled back just like we did here. We pulled back, and now we're ripping to the upside above that resistance support level. So if I were to throw some stuff up here on the BDI, there's us breaking out above it. I'll do candles. We'll do bars pattern here to get the pattern. What I'm going to do is I'm going to grab this pattern here. That's the old one. I'm going to overlay it and scrunch it up. Tell me that this doesn't look similar. So we're going to kind of zoom in here. So that we've got the lead in there. I'm going to stretch this out a little bit and focus on this pattern here. That's the squeeze up that we're getting here, and then we get a break to the upside here, which it's breaking. It's going up and breaking the resistance level. We broke through that long-term, super important resistance level, and we've got, hopefully, a very big move ahead of us. That's kind of the lineup that we're doing there. So that's the squeeze up. Like this is the last bull market. This is the squeeze up that I'm talking about here. That squeeze up is that squeeze up there, and then we've got the way it lined it up is the same way it turned and lined it up there, and now we're ripping to the upside, just like last bull market. And we're right in the spot where it is a big run. A big run could potentially be coming over the next 06 to, could be a year or two, where we get a really big run. Coming on down, we've got during inflationary times, the stock market trades sideways when gold, silver, platinum, commodities outperform. Yields moving higher is the driver of this. Now, this one, they repriced gold back in 1930s. So it completely repriced everything. And it was an inflationary time because of that one thing, the repricing of gold, and then all the commodities repriced with gold. But these times, in 1970s, in the 2000s, and then what I think is coming is going to be a sideways stock market move with interest rates going up. The rotation of money is occurring from the interest rates going up. It's inflation in the system. Interest rates go up. That means people are selling bonds because the interest rates are going up, and money's going to rotate out of the S&P 500, and the S&P is going to go sideways. When interest rates are high and they go back down, that is when you could see the stock market go back up, because the pricing mechanism of the S&P 500 and NASDAQ are based off of interest rates. I see here, platinum is cheap. Tell me the last time in history when platinum traded at a half the value of gold. So we went through a very big recovery phase in real estate, and we didn't have much inflation, low interest rates, money leaked out of platinum. Right now, the ratio's at 0.5, 0.5, which means gold can buy 2 ounces of platinum. When we look at history, where else in history do we see that we were at 0.5? There is no other time in history. Platinum has never been this cheap against gold, ever. Now, does that mean it can't get cheaper? I'm not saying it can't get cheaper. I'm just saying that platinum is the cheapest it's ever been against gold. Back in Weimar, Germany, when they had the hyperinflation, platinum traded at 5.5 times gold. And gold outperformed silver in that hyperinflation, which means platinum was the best performer during that time frame. And you know what's crazy? You take the long-term platinum to gold ratio from like the 1800s, and I'm just going to draw what it looks like real quick because I don't have the chart on me, but um, it basically is a gigantic chart. Oops. It's a gigantic chart that squeezes up, that looks like this. It went all the way to a 5.5x in Weimar, Germany. It came on down, came up, came on down, came up, came on down. And we are like right at the tip here. And it's squeezing on the ratio, where if it breaks, we are going to create a monster move, potentially in platinum at some point during this inflationary period. That is my guess. So I think it is an incredible opportunity to be looking at platinum right now. This is the platinum fractal, kind of looks like we're in the 1976, 1977 timeframe. So we had a big squeeze here. Here's our squeeze, squeezing up. This is the same squeeze that we had back here. Big old squeeze. And if you notice, the way that this is moving is the same that the way that we're moving here. We got a big move in platinum. This is the platinum price ahead of us. Oh yeah, I put Powell on here a couple times. If remember the move lower, the consolidation in crude oil, we got a similar consolidation in just commodities in general. We get the three hump pattern, we get the breakout, and this is the first wave, the second wave, and then the third. Now, during this wave here was a big recession in 2000, 2001, the tech market bubble. Could we still get a pull down like that? It's possible. You know, I don't know. I'm not a genie in a bottle that knows the future, guys. But the big picture view, I think, will look like this. That means that the commodity index, if this is the first wave, the second wave, now we've broken out. I think we're in the third wave, but you can also have false breakouts where if the market were to tank, it could pull us back down. It's possible. But this is the third wave, and then this is the fifth wave blow off top. This says we could go to 1,000. When I took this fractal here, overlaid it on this fractal here, expanded it so the first wave matched. So this first wave here matches this first wave here. And $1,000, you're looking at about 5 times, or 4 times, sorry, 4 times the price move in the commodity index for that to go and match the last commodity bull market. The last commodity bull market occurred in a era where we had declining interest rates and declining inflation overall. Well, we don't have declining interest rates here, and we don't have declining inflation. So that is why this is going to be a bigger move than this potential move. This move here is the first wave. This is the second wave pullback, and this is the third leg of a very big move of commodities. So this is the first wave, the second wave, and this is the third wave on a Kondratiev cycle. Yields are finally weighing on the S&P 500 and NASDAQ. Looks like this could continue. Yields continue to look strong as well, and will weigh on these sectors. We can see a rollover in the S&P 500. That's what it looks like from a longer term view. This is a bearish engulfing pattern. We could definitely see more downside in the S&P 500. We can also look at the NASDAQ, and that also has a bearish engulfing, more downside most likely. And in the short term, you can see the selling pressure that we're getting in the NASDAQ. The next line of support is this horizontal line that I've got drawn in there at about 12,200-ish. TTF gas, nat gas, looking pretty solid here. You can see the clear breakout and the consolidation that we are going under. And this is a big picture view. You can see the big move up, the pullback, and then we're breaking that pullback right now. So TTF gas looks really strong. Oil stocks are at the neckline of an inverted head and shoulders. So there's your shoulder, head, shoulder, and we're right at the neckline. If we get a big move out of crude oil like we saw and that fractals correct that we were playing with, this is going to go way, way, way higher. The measured move from the head upward, we can do that real quick for XOP. So the measured move here, just rescaling it. We'll put it on logarithmic there. So the measured move on logarithmic is this bottom to top. Go to the neck. I've got $834. So I've got a measured move from 830 from 150. 830 from 150. Another one that I talked about is PSCE, which is the small cap. The measured move here is, and this is on logarithmic too, and we've broken that. We've broken to the upside there, doing a little retest. That's 370 from $56. That's a big move, guys. We have a long way to go in energy. So the game here, in my opinion, is it's not so much trying to play with the short term. It's not so much about trying to time the market for a recession. This is going to be a battle against yourself. You want to, in my opinion, I am going to get positioned in these, which I am. I've been positioned since this point here, not in PSCE, but in individual companies. And they have ridiculously big head and shoulder patterns that project even more than this, way more than this. I'm positioned in those and I'm just waiting. I'm waiting, and if I have to ride through a recession, so be it. But that's the projected move. You kind of know what the big picture view looks like in crude oil. And if you guys want to know the companies that I'm in that have these big patterns, just sign up to the website and I can show you all that stuff. They're in my portfolio. Or you can ask during a question and answer session and find them if you guys are interested in knowing the companies that I'm owning. The biggest portion, the biggest thing you need to know is the overall market conditions that we're going over here. Then you need to know the vehicles of how to play it. That is the second step. You're going to get the most bang for the buck riding the best vehicles with the best risk reward. And then you're going to have to know how to read the market conditions for them to continue to rotate money into it. This is uranium. Uranium looks strong to me. People talking about selling. Why? Why are people talking about selling? Look at this. Does that look bearish? No, that looks ultra uber bullish. This is uranium, URM. That's breaking to the upside, guys. Why are people talking about selling and taking profits? Why? Here it is coming on up. We've got a good long way to go, guys. You guys saw that crude oil chart, right? This is going to follow crude oil to some extent. It's an energy, it's in the energy sector. Everything's breaking to the upside. You saw TTF natural gas breaking to the upside. I don't know why people look at Camco versus Dow Jones. We got a long way to go, guys. Now, some of this could be eaten up by the Dow Jones going down. That is true. But everything looking good. Now here's something. Existing home sales look exactly like the KRE ETF regional banks ETF. Could this be an accumulation cylinder? 1, 2, 3, 4, 5, 6, 7 for existing home sales. I know everyone is bearish on the real estate market at this time. What would make me bullish on it? 1, 2, 3, 4, 5, 6, 7? I think what's going to happen is yield curve control is going to come, QE, something on the lines of that, and it's going to push lending through the roof. The lending is what's going to pull the banks out of bankruptcy or out of the positions that they're in with their bonds. It's going to pull them into profitability if they were to yank the interest rates down, and then they're going to lend like heck. There's a lot of lending that's going to go on against new homes. It's going to be very inflationary. That's why I think Powell says it has to be higher for longer, is because he knows that. He's got to price out the millennials from buying homes to tamper down inflation. This here is the setup. And the only thing holding this thing down at the moment is the large increase in interest rates. If he lowers interest rates for whatever reason, the government can't afford its debt, whatever it is, I don't care what it is, then he's going to send this KRE to the moon with also, he's going to send existing home sales to the moon, because he's going to bring the affordability down right into the meat of the millennials' affordability. Commodities continue to outpace the overall stock market. You can see that we've got the first wave, the second wave pullback, and now we're starting to move into the third wave in the ratio against commodities versus the S&P 500. And you can see the S&P going down. This is the 10-year yields continue to surge higher. If you haven't noticed, there's the 10-year yield breaking to the upside. Some people say there's a bigger cup and handle play. This is the handle, and the cup goes all the way back, and then which projects a move way up here. This is the short or longer term outlook. Declining interest rate environment. We've broken that decline. This here is going to cause a rotation of money from bonds and stocks into commodities, as you can see in the previous charts that we've been talking about. The 1970s returns from different asset classes, gold versus the S&P 500 from the last 2 decades. Gold outperformed. Look at gold. This is oil on an annual average price here. These are inflation. S&P 500 with dividends underperformed inflation. This is 3-month T-bills, T-bonds, and BAA corporate bonds. So bonds did very poorly in relationship to inflation. Oil and gold were the spots to be during the 1970s. Here it says by the end of the decade, gold had risen to $512 per ounce, making it the best performing asset of the 1970s. In my guess is that we are right at the beginning of 1970. What would I buy? I would buy gold, platinum, and silver, because remember the risk reward. If gold was one of the best performers in the 1970s, because gold had accounted for the money supply, that's what it did in the 1970s. It's basically, it's this guy accounting for the money supply in the 1970s. Now it cut off, it came from a level, actually let's do this, gold, 01. So this is XAU to USD, and then we can divide it by M2SL. So this is giving me the longer term. So we could buy gold down here, and then gold against the M2 money supply revaluated itself all the way to the peak in an increasing interest rate environment. This here was a declining interest rate environment. This is your pullback in interest rates, and that's why gold has not accounted for the M2 money supply during this time frame, in my opinion. I think that we are going to get a very big move. This is your first wave, your second wave, and then you're going to get a big move up, much like this did in the 1970s. So this was your bottom in the ratio. This here is this here. And we just broke out here recently. Let's zoom in here. I'll show you what it looks like. I'm just going to throw a trend line. We just broke out of this and did a retest here. We're going to break and move higher for gold versus the M2 money supply. We broke out, we did a retest, and here we are breaking to the upside right now of gold versus the M2 money supply. What does this mean? It means we should be looking at gold and silver mining companies. It means that we should be looking at the physical metals and accumulating physical metals. It means that we have we have an opportunity to buy the metals that outperform during inflationary periods with very low risk, to buy it at a very, very, very good time, which is right now. So again, now's the time to be looking. Now's the time to be looking. Check this out, guys. This is crazy. Literally every hedge fund is neck deep in energy shorts. What can possibly go wrong? HF sold U.S. energy at the fastest pace in 7 months, led by short sales. This week's net selling in energy ranks in the 98th percentile versus the past 5 years. We are really, really low in terms of long to short ratio in U.S. energy aggregate. We are very low. What does that mean? It means that when these guys unwind to the upside, that is how all of the stocks that I bought were at the same type of level in oil, net gas, and all of this unwound, which means that we have a very good opportunity here to stay long or get long energy. The companies itself. If everyone's on one side, it means no one owns it. It's under-owned. We have a huge opportunity here across a whole bunch of different sectors where they're just completely mispriced. This market is it's a heaven for me, guys. It is heaven. I'm literally I'm like broke investing. I go from paycheck to paycheck, payment to payment, trying to put as much money in these investments as possible to ride this thing to the upside. Because everyone is they're all on the wrong side, in my opinion, creating these very good opportunities. So that's where I'm going to end it there. Huge opportunity in all of those sectors that I went over. Again, guys, if you need any help with anything, check out finding-value.com. If you want to know the individual companies and the sectors that how I'm playing it with. That's what you can use the word discount in the coupon code to get a discount. If you want to join for the yearly membership, you can do that at any time. Use the word discount to get a discount. But that's what I've got for today, guys. Thumb up for the content, subscribe to the channel, and we'll catch you guys later. This is Finding Value.